employees.
Sorry about that.
That's okay. I'm on camera, smile. So I and my company, or I'm sorry, I and my other team members are not government employees. Our company is a nonprofit licensed by the SBA to again facilitate the second mortgage portion of the SBA 504 program. So having said that, I will now work on sharing my screen to open up the presentation. So as I'm going through information and the slides, I thought I would go through a little glossary, some common acronyms that come up in my world that again will be on the future slides. So we all know what SBA stands for, Small Business Administration. I just touched upon what a CDC is. So for people that I know the jargon, I'll just say, yes, I work for a CDC. And that's kind of how we refer to ourselves as CDC employees. The SOP is the Government Credit Policy Manual. It stands for Standard Operating Procedure. OC stands for Operating Company or the business. EPC stands for Eligible Passive Company. This is what the government refers to as the Real Estate Holding Company, which is typically an LLC. As we all know, most of our clients form LLCs to hold title to their commercial property, and then they rent it to the business. TPL stands for third party lender or first mortgage lender, because again, there's a 50% first mortgage lender, and then I come in as a direct lender with a 40% SBA second mortgage. I referenced the San Jose Loan Center. It's actually called the SLPC, Sacramento Loan Processing Center. These are actual government employees employed by the government, employed by the SBA, that review our loan file submissions for a credit decision, and they also perform servicing decisions, changes to an application or changes to a loan that's already closed and funded. So there's your dictionary within SBA, that things that come up very often. Okay, so these two slides do a great job in highlighting the actual structure of the SBA 504 program. I know David has seen these many times. I've prepared them for his listings. He may or may not include them in his OM, or he'll have these to show to a prospective buyer. And there's a lot more to the PDF when I prepare and send it, but
May I just say one thing? I apologize, Lee, because
Sure.
I love you. And I tell you, this has helped us tremendously, guys. So on any vacant properties, I mean, we have done this, and the people not only like, they even appreciate this information, because a lot of people don't know this is the breakdown, and Lee does a phenomenal job putting this together. And I apologize. Go ahead, Lee.
No, I appreciate it. Feel anybody can jump in anytime, including you. So this is a very small snippet of the actual one-page PDF. There's a lot more information that's included, and I'll send that out to everybody so they can see what the true loan scenario looks like. But I just took some screenshots here. The one on the left would be for a top-tier borrower. You can see the first mortgage estimated at about 3.25, 25-year fixed. There's a 25-year amortization and a 25-year term. So this would be for a top tier, B+, A- or better type borrower. If you look at the one on the right, you'll see that the first mortgage rate is 6% and it's fixed for only 5 years. So the biggest value add that I feel I offer is that once I'm referred to a client and I size up the request per se, I review the revenue trends, the cash flow ratios, the liquidity, the credit, all that good underwriting stuff, I can then help the client decide or make meaningful recommendations to the best first mortgage lender based on their financial profile. Because as you can see, the pricing varies greatly depending on the strengths and weaknesses within the credit file. You might have a client that's considered to be on the weak side. They might bank at Chase, and Chase might say no. Then they might go to their other bank, which might be Wells Fargo, and Wells Fargo's going to say no and turn down the request. And you and the client might feel discouraged that it's not an eligible transaction. But if someone like myself is involved and is working with a client that fits the profile on the right, I have relationships with 20 different first mortgage lenders. Most are banks, some are non-banks, like companies that have access to Wall Street funds, and they can fund those riskier deals, albeit at a higher rate and fee, as we can see compared to these two different scenarios here, but it's still better than renting. And if a client has to pay 5 or 6% on the first, when you blend it with the below market rate of my second mortgage, it's still not a bad deal. And I apologize, this is a little outdated. The September SBA rate is actually 2.97. So it's still under 3%, which is phenomenal. So I don't have to get involved in placing the first. The client might have their own relationships. Their own bank might say yes. But I definitely add a lot of value if the client wants my input, because I'm aware of a few banks that do offer the 25-year fixed on the first for top tier customers. The client might only have a relationship with a bank or two that offers a 25 due in 10. They might not even be aware that they qualify for a 25-year fixed. So I offer that service to my clients. It's a complimentary service because of my position and my time in the industry and the relationships that I've developed with many first mortgage lenders.
Lee,
yes,
Lee,
sir.
I apologize. We have a gentleman that just joined us in office. His name is Andres. He's from KW. He was actually there that evening. And just real quickly, I want to recap this one. So the 50% and 40%, just so he understands and everybody else, I'm sure they're asking the same thing. The 50% is you, the 40%, you're going to shop it with any bank of your, let's say the borrower's choice, correct? Or is it the other way?
Actually, the 50% is the bank. And it could be a non-bank lender. Maybe you've heard of a company called Harvest before. So, yep. But most of the time, the 50% piece is a bank. And then I come in with the 40% SBA second mortgage. That's okay. Go on, David. You have anything else to add?
No, you're beautiful. Go, continue, please.
Handsome.
We love you.
And then the borrower comes in with 10% down. So 50, 40, 10 structure. Oh, another thing worth mentioning, anybody who qualifies for the program gets the same terms, rate, fees, conditions on the second mortgage piece. So there's no risk-based pricing on the second mortgage piece. No matter who they use in my company, a competitor company that's in LA as well, everybody that qualifies for the program, weak borrower, strong borrower,
like this, man.
They all get the same pricing on the second mortgage. It's the first mortgage piece that has to be quote unquote shopped, because every first mortgage lender has their own rates, fees, terms, conditions, amortizations, prepayment penalties, all that good stuff. And again, because of my time in the industry, I have relationships with many different first mortgage lenders. I add a lot of value in helping the client pick the right first mortgage lender for their financial profile. So before I change slides, any questions about these structures or anything along those lines?
And you don't work for the SBA, but you get paid through the SBA program, right?
Correct. So the way my company generates income is part of the interest rate of the SBA second mortgage and part of the fee income. So on this $4 million project, there's $46,000 of financed second mortgage fees, which you can see are added to the second mortgage over here. So my company gets a piece of the fee, and I believe we get some of the interest rate on a monthly reoccurring basis, because we underwrite the loans, we originate the loans, and we service the loans. So just like when I was at Wells Fargo, the bank made a profit within their all-in interest rate, and some of that went to pay for my salary, commission, and benefits. And I'm on the same payment structure here as when I was at Wells Fargo. I have a base salary, from the company. I have benefits, and then I get commission basis points based on the second mortgage piece that gets funded. So we're not loan brokers. We don't charge the client any extra fees outside of the 504 government fee and payment and rate structure. I'm a W-2 employee, and that's how our company generates income. Any other questions on these slides?
Weren't SBA loans initially just 15% down? I mean, I've only done one SBA loan. It was 15% down, and the bank financed 85. Why is it switched around like this?
Sure. So there's two programs in the marketplace. This is the SBA 504 program.
Mm-hmm.
It sounds like you're referring to the SBA 7A program.
Probably, yeah.
The structure of the 7A is the bank or non-bank lender. It's usually a bank. They'll provide 100% of the financing with a government guarantee.
Mm-hmm.
So it's an SBA 7A loan, but it's basically a bank loan with a government guarantee if the deal goes bad. Now, the 7A program has higher rates, higher fees, and if you don't put 15% down, you have to pledge additional collateral equal to 5% of the project cost. So there's a few reasons why I feel, and most others feel, the 504 is more favorable. So on your transaction, they could have put 10% down, but they would have had to have pledged 5% of the project costs as additional collateral, which is typically done by a lien on their house or vacation home or other rental property they may own.
So on your 504 program, the buyer essentially has to negotiate two different loans with two different lenders.
Well, they're going to be working with two different lenders, but they only have to negotiate the first mortgage because everybody who qualifies for the program, strong borrower, weak borrower, they all get the same rates, fees, terms, and conditions for the second mortgage piece. They only have to negotiate the first mortgage piece.
Not the fees, but conditions and stuff.
Well, the second mortgage, you don't have to negotiate because it's all set. All the clients get the same conditions and pricing. It's the first mortgage that has a lot of variables.
I'm just curious. I mean, I've gotten loans on apartment buildings that were just easy. I just refinanced my house and we funded about 3 weeks ago. It drove me crazy. Single family loans now, they'll drive you nuts.
Yeah, ever since the recession, I remember I was a Wells Fargo business banker and I used to refer clients to a home loan officer because they wanted to refi their house or buy a house. And I kept getting calls saying, Lee, help, what's going on? I guess after the recession, the home lending process got very diligent because for obvious reasons. But, you know, during my escrows, the client's working with the bank first mortgage lender. They're working with me for the second mortgage piece. So yes, it's a little bit more work. Maybe during your typical 60-day escrow, the client's going to spend an extra 2 hours because they have to do my stuff and the bank stuff. But I tell them, you only have to do it once for 25 years. You're getting a below market interest rate. You're getting 10% down. It's worth the extra couple hours that it's going to take to get this deal done during a 60-day escrow.
So it's like pounding your head against a wall because it feels so good when you're over.
Oh, it's not quite that bad, Joe. Come on. We'll give you some shots along the way. We'll make it easier. But no, it's not that bad. It's the same.
I know. I'm just commenting.
I know.
So the main advantage is that the second loan, 40% has lower rates than whatever you'll find in the market. So that's the advantage really, right?
Yeah, exactly. I mean, if you look at this chart here, my second mortgage rate is lower than the first. We all know it's usually the opposite. So I'll touch on that real quick. And I probably should have done that already or earlier. The money for the second mortgage piece, the $1,646,000 here, does not come from my company. It does not come from the government. It comes from institutional Wall Street investors who want to invest in what we all know as mortgage-backed securities. So when these investors invest in these bonds or debentures, as they're called, A, they have a government guarantee, and B, there's real estate collateral. So we all know the safer the investment, the lower the rate of the return. Hence, the buyer gets to pay a low rate of interest. So that's the reason why this is a below market interest rate. And so having said that, with the 10% down payment, 25-year fully amortizing, and the first could also be 25-year fully amortizing fixed for strong borrowers, it's a win-win-win. Okay, so we talked about what is a CDC. This is from like the SBA government website. We're a nonprofit corporation set up to contribute to the economic development of its community. The gist behind that is that the more loans we make to small business owners, we're helping them own their own space, lock in their occupancy costs, buy a bigger building to support the growth of the business, which means that they're going to hire more employees, pay more tax. And we are located nationally. There's 210 of us around the country, and we primarily operate in our state of incorporation. We work with the SBA and the private sector lenders, which is the bank first mortgage lender, to provide the financing through the 504 program. So this is the official SBA jargon. Here's how I refer to us. We're a structured lending office with the following departments. Processing team that handles the pre-approvals. They order the third-party reports. We have a formal underwriting team that underwrites the request. The credit memos that the underwriters complete are typically 30 to 40 pages. There's a lot of detail that goes into the credit memo, or the write-up as some people refer to it as. When the loan gets approved by the SBA Loan Center, the file gets assigned to the closing team. They verify proof of insurance. They collect legal documents for the entities. They coordinate with the bank, escrow, title for the doc printing, and the smooth escrow closing process. Excuse me. And then post-closing, we have a servicing team. They perform annual reviews and other post-closing loan servicing actions. So we're set up like a true lending institution, different departments to handle all the different tasks related to funding a second mortgage. The only difference is, we don't have the funds ourselves because, as I mentioned earlier, the funds come from Wall Street investors. So eligibility for an SBA loan, there's probably hundreds of little nuances that the client has to meet, but here are some of the main ones that we come across or want to make sure that get addressed early in the process. The OC, or operating company, must be a for-profit business. So we cannot finance nonprofits. The only time I've seen the government or SBA finance nonprofits was during the pandemic. I think nonprofits were eligible for the pandemic loans, for the EIDL loans, but not for the regular 7A and 504 lending programs. The operating company and its affiliates. An affiliate is another entity that the owner owns, where that owner is either a majority or controlling owner of that affiliate or of that other entity. The balance sheet tangible net worth cannot exceed $15 million. That's a very big number to blow past. Most all of our small businesses have not retained $15 million of profits or have additional paid in capital to build the balance sheet net worth that high. In my 23-year career, I've maybe only seen 2 or 3 companies that were not eligible because of this. The third item is a company can be too profitable for SBA. Net of tax expense, the net income cannot exceed $5 million per year on the previous 2 years. And on these second and third items here, I put possible workaround because the government has size standards for the 504 program and size standards for the 7A program. Regarding bullet point number 2, about 2 weeks ago, I was given the opportunity to help a company. It was referred by the bank first mortgage lender. Their balance sheet tangible net worth was like 18 million. But because they were a manufacturer, we could use the 7A size standards, and the 7A size standards say, in this regard, as long as there's less than 750 employees, then it's eligible. So that was the workaround for that. But there's not always a workaround. It depends on a lot of variables, industry type, how much over it is, what have you. And then we all know the SBA is in place primarily to help clients that don't have 25 or 30% down to put down as a down payment. A $4 million deal done by the bank on a conventional basis is going to be $1 million down payment. Most of our small business customers don't have $1 million to put down. So that's why the SBA came up with these programs with 10% down. But if an owner has too much liquidity in the bank, then they don't need government assistance. They can easily put 25% down and go conventional. There are many times where we cannot move forward because there's too much liquidity, and the client can easily put 25% down and we have to back out. So luckily it doesn't happen too often, but it does from time to time. So whether I was at Wells Fargo or now working for the CDC, every lender has a credit policy manual. And many of the items are, you can't do this, you can't do that, you have to follow this rule, you have to follow this rule. They're kind of restrictive. They make the box tight. But lenders have to have guidelines and rules. They have to remain profitable and not make bad loans. So I'm all for having a credit policy manual. But it's not all bad news or can't do this and can't do that. So these are two of my favorite, what I call favorable SOP policies. And we all remember from my glossary, the SOP stands for Standard Operating Procedure. So the first one has to do with certain types of businesses. Let's say a landscaping contractor that requires land or lot space to effectively run their business. Usually they need that lot or land space to store equipment, raw materials. That land or lot space can be used, net of required parking spaces, of course, to meet the 51% or more owner-occupied occupancy requirement. So I'll back up a minute. In order to be SBA eligible, the borrower's business has to occupy 51% or more of the building square footage. But if it's a business, again, that requires land or lot space, you can count the borrower's use of that land or lot space towards the 51% minimum occupancy requirement. I'll give you an example of a deal that just closed in Orange County for a plumbing contractor. He was renting a building. He was renting space that had a commercial building, and the next door adjacent lot had a single family house with a residential tenant. Escrow closed on both parcels, and the government requires the borrower to occupy 51% of each parcel. Otherwise, one parcel would be considered an investment purchase, and that's not eligible. So regarding the parcel next door that he purchased that has the house and the tenant, he's not occupying a single square foot of any of the structures on that property of the house. It was eligible because net of parking space, he could occupy 51% of the lot space and the house space combined by using the lot to store his equipment and raw materials. So that's very favorable for certain types of industries. Another thing that comes up from time to time, luckily not too often, is when you have an appraisal shortfall if the shortfall is 5% or less, the government doesn't require the borrower to cough up any extra cash. They will, in theory, provide more than 90% financing against the appraised value. So depending on the project size, that could save the client several $100,000 of not having to come up with more down payment if they still want to buy the building. Now, the bank has their own credit policy manual and the SBA has their own credit policy manual. I've been knee deep involved in a deal or two where we got the appraisal back, after 3-4 weeks of, financing contingency due diligence. And the bank first mortgage lender did not want to follow this policy. And the client still wanted to buy the building. And the seller wouldn't renegotiate the price. So we actually had to switch. I had to find a new first mortgage lender that would follow this policy, because just because it's SBA eligible doesn't mean it's bank eligible. And along those lines, another reason why there's value in looping someone like myself earlier in the process is because a bank can decline an SBA request that is still SBA eligible. So when I was at Wells Fargo and I was referring transactions to my SBA loan officer, because I was on the conventional business banking side of the bank, I would ask that person, are we declining it because of a bank policy or an SBA policy? Because I had to properly advise my client and referral source, we can't help you because this doesn't meet the bank's policy, but I'm sure if you try other banks, you'll get financed. Or I would tell them, this is not SBA eligible. I wouldn't waste your time with any other first mortgage lenders or 7A lenders or what have you. So again, banks decline SBA eligible transactions all the time, and some of them don't follow all of these policies, but the value that I offer is that I can usually find banks that will follow suit and play game and help get the deal done. Because again, relationship with at least 20 different first mortgage lenders to help close deals. Any questions on these two policies before I switch slides? Okay.
One question, Lee,
Sure.
and I'm sure others. Let me ask you, for example, we're selling a business opportunity, and just right off the bat, and I know you've already answered, maybe me or the other gentleman, John, who works with me. A business opportunity, can you lend, yes or no? And again, it does not involve property, it's just a business opportunity.
So that is not going to fit the 504 program that I offer, but that's a great transaction for the SBA 7A program. So that borrower could go to a bank and ask for an SBA 7A loan or SBA 7A business acquisition loan. And those are done routinely by all the banks.
And are you able to assist people, say from KW or no, you can definitely assist, yes?
You mean make the referral to a 7A lender? Absolutely.
Well,
Yeah.
Okay. So that's another thing, guys, and one of the things I really enjoy working with these because I'm not going to lie to you. I was going to go buy something myself and I was going to, put my own office or management team, and he was kind enough and helped me. We put the deal to the side, but, it was if it didn't work through Lee, he had the connection that he could send you this way or that way, just because he's been in the business for so long and he's got so many people that he's in touch with. That's another thing, and I'll speak on behalf of me. If he cannot do it or it's not his forte, he's helped me multiple times to put you in touch with the right party to help you with the financing.
Yeah, thank you for that, David.
Of course.
So these are great things that come up from time to time that help us get deals done. Some recently closed transactions. This was done last year for a toy die-cast manufacturer that needed a larger building. This was in the city of Industry. This is your typical what we call rent replacement purchase, meaning they're vacating their rented space and moving into an owned space. So in that situation, we add back all of the non-reoccurring rent expense. And that way, we're not double dinging the customer for rent expense and a new building mortgage payment. This was for a commercial real estate brokerage firm in the Valley. They bought their building last year as well. This is a great example of where you can buy a bigger building than what you need now and rent out the extra space. So this particular firm is going to occupy at least 51 or 55% of the building, and they're able to lease out up to 49% and collect rental income from these third-party tenants to help with the building operating expenses and mortgage loan payments. And then as the owner's business grows and expands, they can not renew certain tenant leases and slowly grow into the building as they need that extra space for their business while it grows over the years. On that topic, the government does not count any third-party rental income to make a deal work. Most of the banks don't. Some do, or some will kind of turn a blind eye if it's weak because they know that income's coming in. But it definitely helps the owner buy a larger building so they can grow into over the years. And that's exactly what happened here with this particular firm. And I have this questions slide. Do I have a few more minutes to go over one other topic?
Yes, you do, Lee, and thanks again for a great presentation, for everybody for showing up and asking great questions. Go for
Sure. Okay, so I'll be quick because I know I've been talking for a while. How do I get to my desktop here? Here we go. Okay. So I just want to go over a couple of bullet points on this. The maximum second mortgage amount is $5 million for non-manufacturers, and the maximum second mortgage amount is $5.5 million for manufacturers, and it's $5.5 million for all industry types. If the client, like if you have a non-manufacturer that wants $5.5 million on the second, they can go green, which typically means they just have to install solar panels and save energy use at the building. Now, the first borrowing tranche could be eaten up by one building or 10 buildings. So there's no limit to the amount of projects that can be financed as long as they meet the lending limits. Let's say a company bought 2 buildings, different locations, and each property has a $2.5 million 504 second mortgage. So now they've maxed out their borrowing tranche. But if they go green, they can get 2 more $5.5 million borrowing tranches. So I think if you take $16 million divided by 0.4, a small business owner can own about $43 million worth of commercial real estate through the SBA 504 program. So there's really almost, I've never heard of a company blowing through $15 or $16 million of just the second mortgage amount. So there is an awful lot of buying and borrowing power through this program that many people don't know about. The other thing worth mentioning, as I discussed earlier, the typical structure is 50-40-10. But for a larger project, let's just say someone wants to buy a building for $21 million or $22 million. I've done the math. I'm aware of a few first mortgage lenders that will go to 65% on the first mortgage piece. I come in with the $5 or $5.5 million SBA second mortgage. The customer comes in with 10% down, and that math allows for the purchase of about a $21 or $22 million purchase with just 10% down. So not every bank will go to 65% on the first, but I'm aware of at least a handful that will. And that's another, I guess, value that using someone like me early adds to your project, because you or the buyer could call 5 or 7 banks with a $20+ million project, and all 5 or 7 of those banks will say, no, we only go to 50. And when you hear a no from so many different banks, you might think it's not doable or not SBA eligible. So I guess the moral of the story is go to the bank first, go to me first. But if a bank ever tells you or your client no, don't kill the project until I have an opportunity, or at least someone like myself has the opportunity to review everything and to let you know if it is SBA eligible or not. And those are pretty much the last talking points that I wanted to mention. And again, I really appreciate everyone's time, and I'm here for any questions that might be asked.
If the borrower is a company, do they look at the personal income of the principals, or is just company income that takes, do you look at?
Sure. So the way we underwrite is we take the business add backs, rent expense, depreciation, interest, net income, and we come up with a pool of business cash flow for what we call for debt service coverage. Then we analyze the personal side of the equation. We look at their personal income, wage income from the business, rental income from properties, and we look at their personal debts. And there's either going to be an excess or a deficit. If they're negative on the personal side by 50 grand a year to cover their personal nut, we're going to ding the business cash flow 50,000. If there's $100,000 or 50, I'll use the same example. If there's $50,000 of excess personal cash flow, meaning that they've covered their personal nut by at least 1-to-1, and there's $50,000 left over, we will add that $50,000 to the corporate funds flow pool of funds for debt service coverage, assuming that that excess came from wage from the operating company. Because if you have a spouse that's not a business owner, that makes all the money, it makes $1 million from a law firm, an unrelated law firm, that's her employer, we're not going to put a whole lot of weight on that spouse income that doesn't come from the business, because then you're over financing the business based on the business cash flow. But we do look at the personal analysis in the regard that I just mentioned. So yes, that's the long answer for yes.
Thanks.
Lee, first of all, thank you for the presentation, and thanks again for supporting the troops. Right, twice by now, our first commercial social event that we had, the first out of many more to come, and you also showed up. It was nice to meet you in person in the grand opening for the West office last week. So thanks again for that.
My pleasure. As I told you and Kim, there hasn't been a whole lot of hosting because of COVID, but now that things have opened up and I'm producing, I have a good budget to continue supporting you guys with your events. So please don't be shy and let me know how else I can help.
And make sure you share your contact information in the chat.
Yeah, Lee, if you can type in your cell phone, email.
Sure.
As well. And good to see all the all the names and all the players on the call, whoever is here.
Annie, do you have you guys discussed about the next, and again, Lee can be part of this, no problem. Next event that you want to put more social event for the commercial guys, or you guys haven't set up a time yet?
Yeah, not yet. Probably towards the end of the year.
Sure.
We'll do something, bigger capacity. And we can chat separately first, just kind of to figure it out, location, area, and we'll take it from there.
Can I say something? And this really got me very upset today, and I want to share it with you guys if it's okay with many. It got me upset, but I learn every day, even though I've been doing this for many years. May I, Manny, or is this not the right time? It's just something just for the new guys, especially the new guys. And I know Monty